Right, so insurance regulator IRDAI has allowed insurance companies to launch Group ULIPs and Combi plans without seeking prior approval from the regulator under rules introduced last year. So, how will the launch of Group ULIPs and Combi plans impact policyholders? It's actually a mix of health and life insurance product. Will it make the entire product line complicated? Let's get all these questions answered by Naval Goel, founder, CEO, policyx.com. Naval, good evening and welcome to the show. So, Combi plans, a mix of health and life. You know, as it is, we see that insurance is quite complicated for a lot of people to buy in general. And then here we are talking about Combi plan, something that gives you a benefit of your life insurance and your health insurance. So, first question to you is, what does this actually mean? And also, group ULIP policies. So, what does this mean, and what is the reason behind IRDAI taking this step?
Good evening, Kavita. So, yes, you rightly mentioned that, launching such products, the motive behind launching such products by IRDA is that, there is a big distribution channel that each insurance company have, right? So, a life insurance company would have, probably a few thousands of insurance agents and bank assurance tie-ups, etc. So, basically, IRDA wants to make use of that distribution channel to increase the penetration of insurance. So that is why it has allowed basically them to, kind of launch Combi products so that the insurance need of a person can be fulfilled by a single company rather than going to 2 or 3 different companies, right? So that is the main motive, to increase the insurance penetration as well as the reach for the insurance companies. Now, what this means for policyholders is definitely that it could mean that the products will become a little bit more complex. As you know, insurance is already very complex. If you go and buy term plan, there are a lot of variants. If you go and buy ULIPs, also there are lots of options. And similarly, choosing a health plan is also a tedious task, right? You need to take care of a lot of things. But yes, this will increase the choices for the consumers. If you are able to take the right decision, I think consumers will only benefit because they will be able to choose from more insurers now, because even life insurance companies would be launching health products.
So let's understand what kind of mix are we talking about over here. And although it is very nice and a good step from IRDA giving the liberty to insurance companies to just file the product and launch it without getting any approval from IRDAI, but then don't you think a check would have been needed from a regulator point of view, since this entire sector is so complicated and there are although it's very well regulated also, a check of any new product would have been a better filter or a level of verification from the regulator's end?
See, insurance industry has always been very highly regulated, and that is also a good thing and a bad thing, because it kind of, delays product launches, it increases the hassle of launching a product, and insurance companies weren't allowed that much flexibility. So with this new chairman coming into IRDA, what the main motive of IRDA has been to kind of reduce the regulation and increase the penetration of insurance. So that is the core thesis behind all such moves. And I think on the one hand, yes, reducing regulation helps in increasing penetration, but also a regulatory check is required, and I think that is sufficiently there. So overall, what we feel is that insurance companies have been allowed a decent amount of flexibility to launch products, but it doesn't mean that they can launch anything and everything. They always have to justify, whether it is just about timing of justification. They don't have to justify before the launch, but even after the launch, IRDA will ask questions on how the product was calculated, how premiums were calculated, and what kind of assumptions were made, and those assumptions have to be in line, right, with the market and the reality. So I would say that this will only reduce the upfront complication, but it doesn't mean that the regulation is going away entirely.
So now let me just understand this Combi product, that insurance companies can issue. So what kind of sum assured, what kind of coverage features are we talking about? What kind of premiums are we talking about that can be decided?
So right now, we have not seen many of such products in the market so far. So insurance companies have been allowed to launch such products, and we are, because if you see, life insurance is usually a long-term product, whereas general insurance, health insurance is a short-term product. It is 1 year, 2 year, or 3 year, whereas life insurance goes up to 20 years, 10 years. So currently, they are basically trying to understand the market to what kind of product will actually fit in, because when you talk about general insurance, you have to take care of yearly inflation, and then you have to basically make sure that the claims are paid very frequently, whereas life insurance claims are usually paid once in a policy term, right? So all of these complications are there. But yes, insurance companies are trying to kind of some companies have even tied up with their general insurance counterparts and combined the product in a way that it is one policy for a customer, but it is actually two policies in the back end.
Now, from an investor or a policyholder's point of view, we always advise viewers and people in general that you should be keeping your insurance first of all in place. Starting off with your life insurance, a separate product, and your health insurance. You should not be investing in insurance policy because you've got a separate set of investment options for that. Now, when we talk about a mixed product, how complicated, although we don't have any example right now, on basis of what we can actually explain people and, help them decide what's good for them and what's bad. But then as per a strategy, isn't it always good to have a standalone life insurance product and a standalone health insurance product? Clubbing it, obviously it will depend on what kind of features are attached to it, but a segregated approach towards your entire portfolio or your planning makes sense.
Absolutely. I am of the same belief that you should at least have one term policy and one health policy. Apart from that, investment should not be clubbed into insurance, because investment you can always do through mutual funds and other better investment instruments. So one term and one health, so it is not much of a deal to kind of tackle. So combining these two for policyholders doesn't really make a lot of sense. But they can always evaluate what kind of products are on offer and then take a decision, because we don't know right now what kind of benefits can combination provide. So if we see those benefits, we will probably change our minds and say that okay, combi products are better. But right now, one term and one health is I think the best combination to go for.
All right. So what do you also mean by Group ULIP, for which the permissions have been given? I think since last year, insurance companies were allowed to issue Group ULIP plans. What does that mean, and what kind of plans are we talking about? Are there any in the market?
So we haven't seen much of Group ULIP plans. So basically, these kind of plans are not retail plans. We usually deal with retail products, and generally health and ULIPs are sold to individual investors.
Also, when we talk about Group ULIP, this is going to, like, if in terms of features, if you could explain how many people could be covered in that, and this also would be a mixed product of insurance and investment, right? So do we have much more investment avenues as per this product? Any idea on that?
Frankly, I would not be able to comment on Group ULIPs, because I have not seen many of such products in the market so far. And we don't really deal with Group ULIPs.
All right, I think that will be all. Thank you so much, Naval, for being on the show and helping our viewers and helping understand actually what are combination plans for which IRDAI has given permission to insurance companies to issue. Thank you so much for being on the show. We'll take a quick break, but then post that, let's talk about your credit and debit card protection. We will have a discussion on card protection plans after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Credit card, debit cards, PAN cards, even loyalty and membership cards all are a critical component of one's personal finance these days. Now, simple to use and store, they are the preferred modes of payment for many of us. But if your wallet gets lost or misplaced, you run the risk of misuse of these cards, and that's where the protection plans come in. Let's bring on board Kanishka Gadi, Head Liability and Banking Business, Anand Rathi Insurance Brokers, to discuss everything about card protection plan. Kanishka, good evening and welcome to the show. Although card protection plans have been there since quite a long time, a lot of people are not aware of it. Obviously, the kind of buzz that's needed is missing for this very essential part of insurance coverage that one must have. So protection of your cards and everything in your wallet. Does that mean when we talk about card protection plan?
Hi, Kavita. So, card protection plans have been in vogue from a very, very long time now. But as you rightly said, that not many people understand what are the kind of coverages that they should be taking and what is the kind of protection that they should be having. So, majorly, there are two large service providers in India who are giving these covers now. They are tied up with many, many large banks in the country, and they've been giving covers. Just to give you a flavor of what exactly they are offering. They are offering coverages on lost card liabilities. So if there is a card which is lost and if there are unauthorized transactions happening on those cards, they get protected. If cards are getting misused on account of counterfeiting or skimming, those kind of unauthorized transactions also are protected. Then the policies go one step ahead and they are covering your cost of replacement of the cards as well. In addition to that, we have coverages for emergency cash advancement. So maybe if my wallet is lost or maybe if my cards are lost and I'm in need of emergency cash, that also gets protected under the policy. We have coverages for ATM duress under the policy. When I say ATM duress, I mean if there is forceful or gunpoint taking cash, which will happen in, say, an ATM, that gets protected under the policy. Pre-delivery frauds also are protected under the policy. So before the card reaches to the right recipient, and if there are frauds that are happening on the card, that gets protected again on the policy. We have coverages for if there is an international travel that is happening, we have coverages for hotel assistance also that is covered under the policy. There are some additional other coverages which some of the service providers have been like loss of documents. So if there is your e-wallet that gets lost or is misused, we have coverages for loss of documents like your passport as well as your PAN card. All of that gets replaced, and that the cost of getting that replaced is covered under the policy. So these are just some of the coverages that are available in the service provider plans which are available right now in the country.
So Kanishka, you know, our lives are online and we do a lot of purchase online. So when we talk about specifically making use of your debit card, credit card or any online purchase or anything that we have to do, what is the kind of protection are we talking about over here for this particular purpose?
So when we talk in terms of shopping that we do online or any kind of activities that we're doing online, it becomes very, very prominent for us to have a cover where there could be counterfeiting of the card that happens online. Like we had a lot of cases as an insurance broker, deal with a lot of banks across the country. So we have seen coverages where counterfeiting is covered, and we've seen where banks have been impacted hugely on account of counterfeiting of cards happening and misuse of cards happening. So for example, there is a card that is put into the ATM, say today, there have been card readers that have been installed in the ATMs. They read those cards and counterfeit cards are made and a lot of cash is withdrawn, or again those cards are taken and used online in a fraudulent manner. So it becomes very pertinent for us to have this kind of coverage under the policy. I have seen plans which are being offered in the country where counterfeiting and skimming is not covered. So if that's not covered, the policy gets redundant. It's of no good use. So it becomes very, very critical for us to go through the finer print of the policies and take a cover for counterfeiting as well as for skimming under the policy, which covers any kind of transaction, which is online, e-commerce. It has to be very, very comprehensive in nature, and that's why it will stand the test of time. As we see, it will stand the litmus test in the event of a claim.
Kanishka, now what about, getting your money back, what about the claims? Now, we know the protection features, and if someone has been a victim of any of these frauds or things that you just mentioned for which the protection is needed, how can you claim your money, and what kind of plans are we talking about in terms of premium prices and the tenure of the coverage that we can get through these plans?
So, see, as I said, that there are varied plans which are available in the market, and each and every individual would want to go ahead with the plans depending on the budget they have for these kind of policies in mind. But it is always advisable to have the most broad form of coverage which is available in the market. As I listed so many coverages before we started. So these are the kind of coverages which are very, very handy, and most of them can get triggered in the event of a claim. So it is always advisable to have all of these covers. And when we talk in terms of claims under the policy, it also becomes important for customers to understand how do they put a claim under the policy, because these are claims which are of very, very typical nature, and we need to have service providers who understand how to handhold you in the event of a claim. So before you get into the process of buying a policy, it's important that you do some kind of research, where you know what is their credentials in terms of the kind of claims that they've handled, what is the nature of claims that they've handled, and how they've supported, and what is the volume of claims that they've handled, what are the nature of claims that they have actually seen as claims coming on the policy and they have settled them. So these are some things that it becomes critical to understand when you're buying the policy. And also, I suggest to each and every customer that when you're taking a policy, please read your policies, understand that what is the process of settlement. It is a part of each and every plan that comes to you. So what are the kind of documents that you need to keep handy in the event of a claim? If you need to go and register an FIR, which needs to be done on immediate basis, that should be done. What are your set of documents? So please ask all that from your service provider, because the kind of policies that we do as insurance brokers, none of our policies go without SLAs, which are service level agreements that we sign with our clients. We have all set of documents which are mentioned in those SLAs, and the client knows that in the event of a claim, what he should keep handy, what should be available, so that it becomes easier for him. And as I said earlier also, that the policy stands the litmus test, it stands the test of time in the event, and it becomes tangible. That is why we take policies. So it becomes critical for you to understand the process. Each and every plan now also, earlier it used to happen only in countries outside India, but now in India also, each and every plan or policy that is given to insurers, which is given to customers, has something like a claims process laid down very, very vividly with the policy document. So it becomes important that we read that and keep those documents handy, so that in the event of a claim, we are not in for any surprises.
What did you mention about the premium, the minimum to maximum range of these plans when it comes to premium?
So depending on the kind of plans that you've taken, these plans start from almost 299 rupees, as low as 299 rupees for an annual basis, and go up to almost 2,800 rupees on an annual basis. So depending on the permutations and combinations that you have done for your coverages, depending on that, the prices go up, go down. Also, there are some service providers or there are some financial institutions in the country who give the CPP, the car protection, as a bundled product. So that product is bundled maybe with travel insurance or maybe with any other forms of insurance. So that when that happens, obviously the pricing goes higher. So pricing options are very, very lucrative in the country, and
it's advisable to
depending
buy
on
a
what is the
separate plan. It's advisable to buy a separate plan and not a bundled product.
Yeah, it is advisable. It is advisable to buy separate plans and not go ahead with bundled products.
All right, Ganishka, I think that will be all. Thank you so much for being on the show and helping our viewers with this kind of a coverage today. Thank you.
Thank you so much. Thank you for having me. Thank you.
On that note, we'll take a quick break, but then post that, let's help you lower your health insurance premium. What are the tips and tricks for that? We'll be joined by Aditya Shah, and we'll also answer your mutual fund related queries after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, with the cost of seeking premium healthcare rising steadily, people belonging to the low and middle income groups are finding it difficult to keep up with the expenses. In India, there are about 34 insurance companies that offer health insurance policies. Now, these plans offer effective financial backing to cover the expenses incurred in due course of seeking treatment for any illness or accident, but sometimes the affordability of these covers can be a cause of concern. Let's bring on board Aditya Shah, founder Hercules Advisor, and discuss how you can reduce your health insurance premium. Aditya, good evening and welcome to the show. So today, tips and trips to reduce your health insurance premium, although it's not recommended, but then it's, if you're someone, for whom health insurance premium could be a very high budget item, then maybe you need a smart way to buy a health insurance policy and reduce the premium. For all those people who want to renew their health insurance premium now, what's the first tip that's coming from you, Aditya?
And there are a couple of ways that we can really do it. But the point is that makes the health insurance very suboptimal. Those couple of ways could be, point number one is, if you're going for a personal health insurance, then you can add something known as a deductible. What is a deductible? For example, if you buy a 10 lakh policy with a 25,000 rupee deductible, so what the insurance company is really saying is that the first 25,000 of any claim will be paid by you. So what really then happens is the insurance company, in lieu for this 25,000 rupees payment, lowers your premium any between 20 to 40%. So that is the first option that we can really use at this stage. Use deductibles of 25,000 or 50,000. But the side effect of this really is on every claim you will pay 25,000 or 50,000, which is not something that is very desirable. The first point. The second point is, you can buy something known as a policy where there is copay. So what is copay? Copay is that you are sharing some amount of the insurance claim with the insurance company. Let me give you an example. If you have a 2 lakh rupee claim that you have on the health insurance company, and if the health insurance company tells you to have a 20% copay, it means that out of that 2 lakh rupees, 20,000 will come out of your own pocket. And every time you make a claim, 20% has to come out of your pocket. If you really do this, again, the insurance company generally reduce the premium by about 20 to 40%. Again, not desirable because every time you will have to pay out of your own pocket, but something that you can use to reduce the insurance premium that you earn. Then the third option that you have really got is introducing something known as a room rent limit. This is one of the most riskiest limit to introduce into a health insurance policy, because your room rent limit does not only apply to the room that you take during hospitalization, but it also applies to the treatment as well as the doctor or the nursing charges that are there. Generally, companies offer 1 or 2% of the sum insured as the room rent limit. If you are able to really adjust in a room rent limit, you will find that the insurer does lower the premium by about 20%. So that is the third option that you can really use. One of the other options that you can really use is, rather than buying a personal health insurance cover, you can go and buy something known as a group insurance cover. Again, these policies are issued by banks, and banks in collaboration with health insurance companies issue these policies. Because there are hundreds of people buying these policies, the risks are spread out, and the underwriting is very simplified, and insurance premium is lower as compared to a normal comprehensive policy. So all of these are situations where if you are forced to lower your health insurance premium. Otherwise, I will not suggest to use any of these. I will suggest to use a comprehensive policy, because that takes care of your entire medical.
Exactly. Now, what happens in these kind of, these ways to actually reduce your health insurance premium is, even if you're getting the benefit, as Aditya also said in the end, that it's really not recommended for one to have this kind of curtailed cover. It's only when you don't have the enough leeway to buy a comprehensive plan. But then, having said that, what about buying in health insurance at an age, Aditya? Can that really help you reduce your premium? Because there won't be any age specific things attached to it, or maybe this can help you get a plan at a lower premium.
Yes, so as young as you buy the health insurance, generally you will not have any pre-existing diseases. So if you don't have a pre-existing disease, for example, the insurer will not apply any loading to your premium, or you will not have a waiting period for any of the diseases that you can really cover. So that's the first point. However, even if you buy young, health insurance premiums rise with point number one with age. Uh, for 35 to 40, the premium is one. Then from 40 to 45, the premium is twice, is another one. Then 45 to 50, the premium is another one. So as time really goes on, you cannot avoid the rising health insurance premium. On top of this, every time the health insurance company takes a premium increase, that also compounds to the increase. For example, during COVID time, health insurance companies were flooded with claims because of which they had to cover for their losses and they started to increase their premium. So net what is really happening here is uh, you buy young, then you can avoid the loading and the pre-existing waiting period. However, you cannot still avoid the rising premium increases which happen every 5 year period, as well as the hikes in health insurance premium that the companies really take. So net, it's a very difficult situation as time really goes on. Uh, by the time you are 50, 55, 60, health insurance premiums shoot up, and there is no logical solution that you can attach to at this stage.
All right, so these are the steps through which you can lower your health insurance premium. But then we move on, and time to take our viewer queries on the show. And for all those viewers who are watching us and also want to send us your queries, you can WhatsApp us your questions on 865-797-4571. You can also email us your questions on themoneyshow@etnow.tv. So that's the place where we keep waiting for your financial portfolio queries. Okay, first question is from K. Satya Narayan, and he has invested in Aditya Birla Sun Life Equity. He has ABSL Money Manager Growth, Bandhan Flexi Cap. He's got Franklin India Advantage, HDFC Flexi Cap, HDFC Index Fund, Nifty 50 Growth, HDFC Money Market again, ICICI Pru Long Term Equity, Tata Equity Nifty 50 Index, and he's got Tata Equity PE also, Nippon India Index Fund, SBI Consumption Fund, Nippon India Index Fund also. 13 funds as far as I can see, Aditya, and I don't have him on the phone line. I really wanted to understand why this kind of a mix in his portfolio and whether he's been recommending or going through any financial planner. But all said and done, with the limited information that we have, how can you help him?
Ma'am, first of all, the investor must attach his investment to any goal. He's clearly not done that, so that is the first advice that I will want to give. Second advice is there's no requirement of 13 funds inside the portfolio. He's too much over diversified, and he's owning every stock that is available in the market. I would suggest to him not to really do this. Cut down his investments into 4 funds. The 4 funds that I have shortlisted is Nippon India Nifty 50 Index Fund, Parag Parikh Flexi Cap Fund, Mirai Asset Tax Saver Fund, and Canara Robeco Flexi Cap Fund. So all in all, into these 4 funds, you should do his SIP. First of all, stop his SIP into all of these funds, then redeem the existing funds and go into all of these funds. 13 funds required, more or less 3 or 4 funds does it for him, and be very disciplined and consistent in your investment for at least next 5 to 10 years. You should be okay.
All right, we could have given him an elaborate solution only if we had more details on us, but then we move on. We'll take Prakash's question, Aditya, and he wants to invest 20 lakh in lump sum or through STP over 2 to 3 months, and the period of investment is 3 to 4 years, and he's expecting a return of 15 to 18%. He wants you to draw him down a strategy of specific funds. So expectation of 15 to 18%, do you think that's a lot to expect, and maybe he needs to just tone down his expectation on returns?
Yes, that was the first observation that I really made. Consistently make 15 to 18% return on a mutual fund will be very, very difficult. I will suggest to tone down the expectation to about 10 to 12%. That is a more realistic expectation that one may really have. So point number one, tone down the expectation to 10 to 12%. Second point is don't invest lump sum, 20 lakhs if you have got. Invest over a period of 3 to 6 months. That will be really helpful, and that will help you average down any rise or fall that may happen in the market. Since you've asked me for funds, I suggested three funds: Parag Parekh Flexi Cap Fund, UTI Nifty 50 Index Fund, and DSP Quant Fund. Since your time horizon is very short, it's just about 3 to 4 years, it is very imperative to stick to large cap funds or to a flexi cap fund where the volatility in the fund is really less. Stick to large cap fund, have an expectation of about 10 to 12% return, and invest these funds over a period of 3 to 6 months. You should be on.
All right, we move on. Ramesh wants to invest, he is investing in 1,500 in Nippon India. He wants to know if he can continue investing in this mutual fund. Again, we don't have him on the phone line. We don't know what other funds he has in his portfolio, Aditya.
Yes. So what he's done is he's invested in the Nippon India Nifty 50 Index Fund. It is a large cap fund which tracks the Nifty 50 Index. So according to me, if he has a lower risk profile and if he wants low volatility in his portfolio and is satisfied with about 9, 8, 9, 10% return, should be okay, no problem, should continue. And passive strategy is a very good strategy to continue for the large cap funds.
All right. We'll take Sunil Singh's question, and he says that he wants to invest 50 lakhs in 10 years, and he already has Tata Large and Mid in his portfolio, ICICI Large and Mid, Aditya Birla's Flexi Cap, and SBI Small Cap.
So, ma'am, the funds that he has invested in, 4 funds are there. More or less, he needs to change these funds a little bit so that he, together with a small cap fund, he introduces a little bit of stability inside his portfolio. What I have done is I've introduced SBI Small Cap Fund, Parag Parekh Flexi Cap Fund, and UTI Nifty Next 50 Fund. These are the funds where he's got a Flexi Cap Fund, he's got a Mid Cap Fund, he's got a Small Cap Fund. So net, he needs to split his SIP equally into all of these 3 investments, and he should be okay. He should increase his SIP because with the current amount of SIP, he will not be able to reach his goal. So he should either increase his SIP by 10%, which is feasible, or try to elongate his goal. Any of the two will really work. But these 3 funds together with an increase in SIP will work.
What should be the approximate increase in his SIP amount?
And 10% every year is something. I say I will want an increase by 50%. But looking at the life situation of individuals, it is very hard for individuals to abruptly increase their SIPs. So I generally tend to suggest the clients, if you're able to increase your SIP amounts by 10% or 15%, which seems to be very feasible and very logical, that should be really okay. And try to increase it by 10 to 15% every year, or maybe every second year, if that's logical. But try to increase is the message.
The approximate amount, as in if today he wants to, he's advised to increase his SIP, and if he's not able to, obviously he'll do it gradually. But what's the ideal amount that he should be investing for 50 lakhs in 10 years?
Well, he's investing around 13 to 14,000 rupees right now.
Right.
I suggest that he should be investing about 20,000 rupees in order to reach his goal, which is nearly about 40 to 50% higher than the current SIP amount. That's
the figure for Neil, just in case if you happen to see the show, that's the amount, and if you can, then maybe just increase your SIPs. Mr. Sridhar's question we'll take, Aditya, and he says that he's planned to invest in diversified fund for 10 to 15 years time, and he wants to invest 15,000 per month, for which he wants a fund recommendation from you.
So, ma'am, I don't know what the goals for the investor really are and how much money he wants to accumulate over a period of 10 years, 10 to 15 years. Since the investor has said that he wants to go only into diversified funds, I suggested 2 flexi cap funds where the fund manager has a complete authority to invest, and they are completely diversified across large, mid, and small, as well as across the sector. So, Parag Parekh Flexi Cap Fund and Canara Robeco Flexi Cap Fund, those are the 2 diversified funds where he can invest in. Consistently doing SIP to these 2 funds equally split should help the investor.
All right, that will be all. Thank you so much, Aditya, for being on the show and helping our viewers with their financial portfolio queries today. And we move on. Radhika Gupta, MD CEO, Edelweiss AMC, has some valuable advice that she would like to give her son about making and managing money. These are some valuable words of wisdom wisdom coming from someone who has a treasure of just of experience when it comes to managing money. My colleague Snehisha caught up with her in a conversation about how to build healthy money habits among children, how to introduce them to the concept of money and savings, and much more. Listen in.
This is a very personal thing, but I think, as your child grows up, money habits is really not about investing for this generation because, that really comes later. I think money habits are about some of the more basic things about money, about having gratitude, about realizing that, there is a certain amount that is enough and that you should not be greedy. If you have gratitude, then you will naturally learn to save. If you don't have greed, you will know the importance of enough. It's about realizing that money is really a balance. It serves a purpose, it makes life better, but it's also not the be all and end all. So I think these meta habits are far more important. Now, as your child goes up, of course, you will have conversations, and you go to a store and a child wants something and you don't want to buy it, then that's an occasion to have a conversation about money. I don't think you sit down and explicitly have conversations about money. That's boring. But in day-to-day situations, when you make all kinds of decisions, that's when you can start having the basic conversations on values that relate to money. And of course, as children grow up, a lot more is in store.
Right, and as you said, gratitude is it's a very important trait to have when it comes to talking about money. And also in your tweets, you've also addressed gratitude. So can you elaborate a little bit more in what context do you mean gratitude? Does it mean grateful for having the money that you were born into, or does it mean you should be satisfied with what you have? Can you please elaborate a little bit more on the context of gratitude?
So I said it in the context of my own child and many children of this generation who I think grew up with a lot more than their parents. Like my son grew up with a lot more than I had, and I grew up with a lot more than my parents had. And as India gets prosperous, children are growing up in a much more abundant India, where everything is consumerism and everything is available. But it's important to value what you have, what your parents have given you. The second context of gratitude is that, when you value what you will have, you have to use the money that you have got to create opportunities. Perhaps my father could take less risks. He took on a government job than his father did because he had the pressure of earning. I could take a little more risks, and I think my son can take far more risks. So it's also gratitude is about realizing that my parents worked hard to give me this opportunity, and I have to take a leap from here and use the wealth or money to create opportunities and take those risks.
So in a recent series of tweets that you've recently tweeted, you've addressed to your child and where you've said that you'll see eventually that mutual fund sahi hai. So what is your rationale when you say this, and what are the trends that you see shaping up with the mutual fund space in India?
Look, I think as SEBI chairperson said in the Amphi inauguration that there's no better vehicle for the retail ordinary Indian to invest in their mutual funds because of the cost structure, the transparency, and the range of options that you have. I think again of the past generation was one for whom mutual funds is an alien word, but I joke that mutual funds will be so familiar for my child that perhaps one of his first words will be sahi hai. And I think, you are actually seeing a lot more young Indians invest in mutual funds. Incidentally, I started an SIP for my son. He was a few months old, so he started investing in mutual funds much earlier than we ever did. And I think, by the way, I would encourage a lot of parents, after your child is born and the basic docs are completed, why delay the process of investing? Get an SIP started towards education or any other goal for your child using mutual funds.
Let's quickly talk about you now. So let's go a little back into the past, and as a child or as a teenager, are there any money mistakes that you've made that you look back at and regret, and are there any mistakes that you would like your child to avoid making?
No, I think it's a meta mistake, and it's the fact that, and I pointed this out in my tweet, I used to let money define my sense of self-worth, because you always made comparisons, oh, this one is richer, this one is richer, and, money should not define your sense of self-worth, and that's one thing I don't want my child to do.
So Radhika, as we wrap up, could you quickly explain me, let's say if you were talking to a 10-year-old child, how would you explain this child the power of compounding?
This is a hard one. I don't think I have an immediate answer. I'm sure with time I could come up with some more clever analogy. But just the fact that if you study, let me give you an example. A 10-year-old is probably studying. If you keep studying incrementally, you'll actually have to put in much less effort to become a better student and to achieve the same results in class, because knowledge also compounds, right? So if you study hard in the first year, you study a tad bit less, over time to achieve the same outcome, actually, you won't need to put in as much effort. That's compounding there for you.